Good afternoon, everyone. I'm Millie Hong, Head of Events at ASIFMA. Thank you for joining us today at this virtual event, EU Policy Response to COVID-19 to Support the Markets and Economy. Let me introduce our host today, Mr. Mark Austin, CEO of ASIFMA. Mark, over to you, please.
Thank you very much, Millie. Very excited to have you here today. We're going to be talking through the EU policy response to COVID-19 and the support that's been given to the markets and the economy, as Millie mentioned. Before introducing the speakers, what I wanted to do was first thank the endorsers. One, the European Commission office here in Hong Kong and Macau, as well as COFIA, the trade association in Korea. And maybe one other housekeeping note before we get going. We're going to have some dialogue with the two speakers, but if you want to ask a question anytime throughout the whole event, please click on the Q&A box and ask that question, and I will do my best to put as many questions as possible to the speakers throughout the course of the event today. If we have time at the end, we may allow for people to use the raise hands functionality to raise a hand, and then I'll ask people to speak and ask a question. I'll just ask you to be very brief, though, if we have that time at the end. So maybe without any further ado, I'd like to introduce the two speakers we have today. Roxana de Carvalho, who's Head of Governance and External Affairs at Esma, and Almoro Ruben de Servan, who is from the European Commission. So we're going to cover quite a bit today, and I'll just briefly cover those topics. The first is, what are the measures the EU Commission and ECB have put in place to support the markets and the economy, and how is this being coordinated with member states, with the member states' measures? And then in addition, we'll talk about what the sectors and markets, what the sectors of the markets are and aren't responding to the central bank measures. And then, are there remaining hotspots, examples, equities, certain sovereigns, etc. And then, what signs to look for in terms of future stress as well as we navigate through COVID-19. And then, how do we think COVID-19 will ultimately change the regulatory environment going forward? What are some of the risks? What has COVID-19 shown us from existing regulation? And then how is the EU handling the trade and economic tensions arising from COVID crisis, including the Asian countries? And then finally, what about the impact on the EU sustainability agenda, which we're all very kind of familiar with as being a high priority? So to kick off, I'm going to hand over to Almoro from the Commission. He's going to set out the big picture and cover a lot of those points. And then he'll talk about what they've been doing on the finance side, in particular around banks, and then the international dimension. So over to you, Almoro. Thank you.
Many thanks, Mark. Can you hear me? I hope everything is fine in terms of connection.
Yep, we can hear you loud and clear.
So good afternoon, everybody, and good morning for those of you who are listening from Europe. And many thanks for the invitation. It's a great pleasure to interact with many people from distance. And indeed, one of the advantages of working remote is that contact with distant people is from other regions is much easier. Still missing the travel to some extent, and being there, and we met with Mark back in November, it was better than interacting today, but I think it's still a fantastic opportunity. I will cover three issues in the broad introduction, and then I hope cover much more during the Q&A. One is the macro response in Europe by ECB, member states, and Commission. And I think it gives an introduction also on the complexity of the European system. Then I will focus a little bit on the European banks, actions by supervisors, also actions by us in terms of adaptations of the regulatory framework, and transparency and sensitivity analysis by EBA, who is providing a lot of information on the European banking system. And finally, I want to say a brief word on international cooperation, because I think it's we're all focusing on what happens at home, but it's fundamental that we keep working together because the crisis will have put a lot of strains, and international cooperation is even more important going forward. I'm not using slides because I don't think they lend themselves, but I'll send to Mark and the organizers a series of links where you can find more information for those who be interested. So let's go to the macro measures. When the crisis hit in Europe, it was March, essentially. Lockdowns were introduced throughout Europe. The main immediate concern was about liquidity risks. And that was taken care of very rapidly by the ECB, who put in place broadly two sets of measures. There's much more, but I try to simplify. One is a bond purchasing program. It's called the PEP. I can't remember what the acronym is, but it initially was around 650 billion. And then they doubled it to 1,300 billion euros with that substantial amount. This has taken away a lot of the pressure on the market, and has given time and space to member states and the Commission to put in place measures for the recovery. So it's a very significant intervention. I can talk more about that. Member states took a number of measures. I leave aside the health context, obviously, because that's not the object of subject of today. Three sets are more directly related to finance. First, almost all member states put in place job retention, short employment measures. And they are relevant for finance because they actually reduced the burden for SMEs and for large firms. And the schemes varied in amounts, were often based on existing schemes in member states, but actually cover between 30, 40, and 80% of monthly salary. So it's pretty significant. Second, member states introduced or enlarged guarantee schemes to support bank lending, in particular to SMEs, with again different levels and format depending on countries. But these took away a lot of risk from the bank and kept a lot of lending and money flowing to firms. And third, a number of member states also introduced moratoria, for instance, to prevent mortgage holders to being foreclosed. And again, moratoria has different designs, etc. But the idea is, because of the type of shock, was to smooth out and to take the time to the economy to recover, and so to avoid the cyclical effect. The measures are different from member states to member states for a number of reasons. The crisis hit everybody, but not exactly in the same way, with the same intensity. For instance, the first countries hit, like Italy and Spain, were hit more. The other had more time to prepare, more time, in the case of 1 or 2 weeks, but makes a huge difference. In some cases, member states had already schemes in place that was quicker to implement than introducing new measures. And then, frankly, third, the financial situation of member states is not the same. So some have more means than others. The fiscal position of Germany is stronger, and so they had more means to support population and economy. So, and then let me turn to what the European level did. I'll focus on 4 aspects. One is we relaxed the European constraints. So the fiscal framework, which is the Stability and Growth Pact, which is capping deficits notably. And we also relaxed the rules of state aid, which try to reduce distortion, normally reduce distortions in the single market. But in a context where state intervention was necessary in the very short term, we thought it's necessary also to allow more significant state intervention, being aware that there are risks of distortion down the road. So these are temporary relaxation. Second, we coordinated a number of measures in relation to the health sector. And I'm mentioning this because this comes back on the lessons that we derived from there for the economic part. For instance, what we did, we launched joint procurement schemes for member states on personal protective equipment or on medicines, and that's actually worked because of the size, we have more buying market power in doing procurement. So that's helped in particular in the small member states. And also we work to ensure that the measures restricting the mobility of people were not impacting the mobility of goods. Green lanes for trucks across borders, ensuring that logistics continue to function, etc. Because we have integrated supply chains across Europe and a very integrated, for instance, agri-food market. So we try to avoid that the lockdown also doubled with a contraction of the single market. And to some extent, this worked fairly well. It was a very good lesson for everybody to see that having integrated economy needs and benefits from collective responses. We set up 3 additional measures which we are rolling out. One is a scheme to co-finance the short employment measures. It's called SURE. So that is designed in particular for countries in the South Europe which are paying a higher interest rate on their sovereign. The second measure is a scheme to support investments involving the European Investment Bank that actually is still being finalized. And a third scheme is to support investment by member states directly in the health sector, and that would be funded by the European Stability Mechanism. And then fourth, and that's the most important aspect that I'd like to cover, is the proposal put forward by the Commission at the end of May for a very, very ambitious finance package to finance the recovery. So let me give one element of context. In Europe, we have budget plans which are multi-annual. In states, it's annual budgets. We have a multi-annual budget over a period of 6-7 years. The reason why we have a long-term budget is to avoid permanent negotiations on the budget, which is something which is all national political systems are spending a lot of time, and to allow to the European level to focus on long-term issues, investments, research, infrastructures, regional development. From a macro perspective, the budget is small because it's 1% of GDP, so it's way down the size of other federal budgets, for instance, in the US, which is, I think, 40% or 30%, but still it's a completely different scale. But this reflects the fact that we are not a federal state, but a union where member states have decided to share sovereignty on a number of areas with a common legal framework and a democratic governance, because we have 2 co-legislators, Parliament, which is directly elected, and Council, which is composed by the 27 democratic government. And the Commission is the executive, but the Commission President is voted by Parliament, and the individual commissioners are also receive assent from Parliament. So there is a democratic setup, and there is a shared sovereignty, and we are sui generis constructions in the international context. I think it's important to understand. So what we're proposing for the recovery package has 2 main components. One is we propose to increase the size of the multi-annual budget and to continue focusing on, in particular, on green transition and transforming and helping the digitalization of the European economy. And the second, we propose it to complement with an additional fund of around 700 billion euros, which would be raised in financial markets by the Commission, in part with guarantees from member states, in part covered by future revenues, which would be deriving from future taxes that we need to put in place. These would be issuance of long-term bonds. One part of the discussion is how long would be the issuance and under which conditions. The relevance of the proposal, frankly, it's extremely significant. First, it shows that together we can achieve much more. And it goes back to what I was saying on the health-related issues. The lesson from the crisis is actually together we can do more than if we go alone. It shows that there's also significant solidarity among member states. There are still discussions going on. Some are, we have a group of member states which are more frugal, others which are more keen to get the money because there will be transfer between member states, fiscal transfer between member states, and obviously there is some reluctance, and there is attention on how much this is designed to focus on investment and how much it is transferred, and there's a lot of politics around it. But also it shows that the EU level can act as a multiplier of what member states can do, and I think for an economic and financial point of view, this is very important. And this takes place in a context where the economic contraction will be very significant. Forecast now is minus 7.4 GDP for 2020, and only partial recovery in 2021 of 6.1, but the risks are on the downside. It's with a new spread of the virus or because of economic difficulties. So very important, I think, that we show collective strength, and we hope to get agreements from member states on this package in July, even if this will require a lot of political discussion and courage. Let me turn to the banking system, which is more of direct interest for a lot of colleagues around the call. What we looked at together with, in particular, the European banking authorities and the SSM is what is the situation of the European banking system and to what extent it is ready to how prepared it is in front of a downturn of this size and shape. So what the three things we've done more broadly in a quick summary. The first is supervisors, the SSM in particular, created space in the balance sheet of the banks, releasing a lot of space, notably on Pillar 2 issues. Second, based on what the Basel Committee agreed at the beginning of April, we put forward a proposal for a very targeted change in particular, to give more space to loss recognition, to cater again for the type of crisis that we're facing. And third, we've done the analysis, the EBA in particular has done a sensitivity analysis on a very large set of European banks based on previous stress test data. And the analysis actually shows that today banks have around 15% core Tier 1 capital. So there's a 500 basis point of margins to withstand the crisis. And this, frankly, is thanks to the capital accumulated in the last 10 years and by the regulations we put in place in the last 10 years to respond to the previous crisis. So the analysis shows a lot of resilience from the banking system, with a few, probably some few banks on a slightly weaker position. But that's also where the EBA transparency exercise, which is giving a lot of data to all analysts and investors on European banks, comes in and helps investors to make a judgment of individual situation of banks. So, because there's, I think, an excessive tendency of markets to say EU banks or Asian banks, while in fact the situations are very different from one to the other, and I think applies to both European banks, and Asian banks, and US banks. So the work of the EBA is fundamental for investors and analysts to look at this closely. Final point is on the international dimension, and then I'll shut up. We've worked a lot in the FSB and the G20 to ensure good coordination, analysis of problems. The most important element also was to look at whether the international standards were flexible enough to cater for the type of shocks we were facing, and it seems that so. And so we're also checking in the FSB whether the measures taken are consistent with the standards, because if that's the case, actually shows the strengths of the international standard setting system, which caters also for these types of shocks. It's not a financial shock; it's a real economic shock. We also work on the critical nodes, dollar funding at the beginning, but it seems now not a less a problem, thanks also to US Fed measures. Liquidity concerns, notably on the non-bank sector, because the liquidity for banks, that's the central bank catering for that. Counterparty risk, and also the need to ensure continued lending by bank while ensure their resilience in the medium term. There's been interesting analysis by the Bank of England, which was showing that it was the interest of banks themselves to lend more now and take more risks, because if collective lending would go down, actually the crisis would become worse, and the bank would then be on the losing end, lose more down the road. And then we've engaged bilaterally with a number of partners to exchange information on crisis measures. And I think these bilateral contacts will be very important going forward, also how we get out from the crisis. And for instance, some of you might know, we have a regular EU-Asia forum between, from the EU side, Commission and Esma, and from the Asian Pacific side, the market authorities, which normally gathers in the IOSCO regional group. And we have a regular meeting combined with an industry event to exchange views on stability concerns and on market developments. I think we had to postpone the event, which was scheduled for October. I think it will take place in March next year in Bangkok, if my memory is correct. And I think we attach a lot of importance to continue work, because frankly, it is essential, and we're working with associations like ASIFMA also to understand problems and to ensure that there is a good international cooperation. So let me conclude for now. We have a very, very significant, in many aspects, unprecedented crisis. At the same time, we have a banking system which is resilient and might this time be actually a part of the solution, while last time was part of the problem. And we acted at European level very, very thoughtful, very, very innovatively, and to actually hope to get to the recovery with Europe in a much better shape. And I hope then in the responses also to cover what we're doing in a number of areas like green finance, digital, or actually on our flagship projects, which are more to European, like strengthening banking union and developing capital markets union. But I'll stop there, and I'm sure there will be questions from the audience. So happy to hear from colleagues. Thank you.
Thank you very much, Almoro, and thank you for giving us a very comprehensive, big picture of all the measures Europe has been taking, as well as the stuff specific to the banking sector, and then that international dimension, which is so important. You mentioned obviously the EU Asia Forum, and as you know, and you referenced, we have our annual event next to that forum, and we've done that for many years. So we look forward to that continued cooperation, and we now know it's moved to March 2021, so we'll do it there. And I think maybe some of the audience maybe lost a little bit on them that how big of a change to the way the EU has traditionally operated with the measures. I think you said 750 billion. That traditionally the EU has not made transfers between member states. In the way that, say, other countries, states within other countries or provinces in other countries has been, sort of relatively commonplace. So that's a very big change to policy, as well as actually issuing common bonds, or anything that's backed by guarantees. And so I think that just goes to show that it really undermines the combined effort that the EU has made in, as you said, this unprecedented crisis. Maybe before turning to Roxana on the market side, there's one quick question here. I mean, you touched on it a little bit on the end, but maybe you can quickly answer it. The question is, it's admirable that the EU Commission is very proactive. There's a proposed euro 11.5 budget, I think it's billion budget reallocation for stopgap measures while waiting for the ratification of next gen EU. Could you please discuss what these stopgap measures will be and when are these expected to be implemented? Is that something you can comment on, or?
So, if I understand the question is because the negotiations will go, and the next wave of programs go into next year. I think there is a demand to have measures kicking in already this year, and so there are discussions taking place. This is not finalized, but there are proposals from our side to try to front load a bit of that. But I don't have the details. Also, because I don't think that's fixed in any particular way, but this is part of the package and the discussion to have the ability to front load some of the measures. Some of that are the target measures for the unemployment schemes and for the health sector, and then there is the possibility to front load on investments, but that's not finalized yet.
Okay, great. Okay, thank you very much, Amor, for that answer. And I'll turn over to Roxana now, who is going to more focus on the markets and how Esma has been coordinating action in response to that in the EU, and also what the member states are doing on a range of things, including the fund side, the credit rating agencies, short selling measures that have been taken. So over to you, Roxana.
Thank you very much, Mark. I hope you can hear me well.
Yes, very well.
Okay, thank you. So maybe just as a very short introduction, so that I explain you how I can guide you through the measures we have taken. Probably for those of you who don't know ESMA very well, we have actually a function of which is related to market monitoring and risk assessment. And I'm going to share with you a bit of perspective on the financial markets. And on the other side, we have, as part of our supervisory activities, whether it's direct supervision, that is obviously direct measure, but on the other hand, where national regulators have to direct supervise the entities, we have a function of coordination of measures at the European level, which was particularly, I think, relevant for the period we have passed through. So I think probably the big difference in this crisis compared to what we saw in 2008 is that we had quite a lot of data, and that has helped us in order to ensure that we have an analysis of the situation and we prepare for the intervention measure. What we saw, I think, and it's still visible in the market, we had a massive decrease in the equity market, and we had a huge correction in March. We had very high volatility levels comparable to the global financial crisis also in March, and from beginning mid-April we saw a remarkable rebound. Obviously that was in light of the massive public policy intervention in the EU and also elsewhere. But that situation is not necessarily stable, because we also saw there were some decrease again over past week in response of the forecast which were published by the IMF and the OECD. I think on the credit side, we saw some subdued movements recently, a 40% decline in CDS indices since March, but spreads are still very high, 80% higher than the pre-COVID situation. On the sovereign bonds, we observed also that there are some improvements in the spreads, but still remains very high. And I think most notably what we noticed that there is a decoupling of the financial markets compared to what is in the real economy. So despite the fact that we had some rebound in the asset prices, there is a continued deterioration of the macroeconomic outlook of business activity and of confidence indicator. We saw also there are differences between how markets are reacting. We saw faster recovery in the US markets compared to the one in the EU. And there are also differences between sectors. We saw that health and technology are outperforming, but there are financials, automotive, energy industry, which are underperforming. And finally, I think there are also big differences between issuers. There are the large firms which were able to tap markets and also were able to put in place quickly some measures, while other smaller firms and riskier face more challenges and risks to be hit again by the crisis. think in this context, we also saw that the asset management industry experienced some turbulences. There were signs of price dislocation, of massive outflows over a certain period. The performance decreased across different asset classes in line with the market valuation. And in that context, we also saw some suspensions which happened in March. On the credit rating agencies front, we noticed the deterioration of the credit ratings across the issuers starting in February, but the peak of the downgrades was in April, and obviously this is correlated with the decrease in valuation and the forecasts which were announced by the IMF in relation to the economic recession. I think the probably only good news somehow were in relation to the infrastructure in the financial markets, where despite a very high level of trading volumes, we haven't noticed any major disruptions according in the EU. Obviously, that is a result of the measures which were put in place after the previous financial crisis when we enhanced the regulatory framework around the clearing houses. Also, the central securities depositories were put under stress. There were some settlement fails in March, but those fails were mainly caused by operational issues and liquidity issues, and these were resolved quickly. So let's say that on this part of market infrastructure, the situation was not necessarily very bad. So in this context, you can imagine that we had a very intense period when we tried to, together with the national regulators, to coordinate, to discuss, to monitor the risk and see what are the measures to be taken. And I think what is important to share with you is that from the very early in the crisis, the key message we tried to provide the financial markets participant was in relation to ensuring the business continuity while respecting the legal framework which was in place, and in the same time providing assurance that regulators would try to support a business where is it possible and provide some reliefs. But our objective was to maintain the markets open, because we know that the markets are vital for the functioning of the economy. And that was, I think, the key objective that we had in mind. So going now through a list of the measures we have provided and probably immediately linked to the keeping the markets open. I think one of the first measures we put in place was a decision to temporarily require the holders of net short position in shares to actually report position when they are reaching or exceeding 0.1% of the issued share capital. And that was a precautionary action which was essential for the regulators to monitor the developments and see if there is a need for any other more intrusive tool. Actually, last week we have renewed that decision for another 3 months, because we believe that while the markets have partially recovered since March, there is still uncertainty in the system and there is a potential threat to the stability of the financial system. Linked to that, in March in 6 member states, there were a decision to ban the short selling. Those are powers which are related to our to the national competent authorities and not with us. We had a power of just ensuring, give a positive opinion, and we thought that was the right measure to put in place in those markets. Those restrictions were in place until mid-May, when we coordinated and aligned a non-renewal of all the emergency restriction, and therefore today they are not in place anymore. In the funds area, as I mentioned earlier, that was a situation which required particular attention. We saw some ETFs which had to manage massive outflows, and some money market funds which faced significant challenges, triggering the use of liquidity management tools. And that required a particular coordination between ESMA and the NCAs, because there it's the national competent authorities who have powers. But what we try to do in order to ensure that we have control over the situation was to have up-to-date situation, very often reporting on what is the situation in the market. There were cases when we had reporting more than twice per week. It's something which we are still monitoring. You have also probably heard that the European Systemic Risk Board also put in place a recommendation asking the authorities to work together and to ensure supervisory engagement with respect to investment funds. In particular, those funds who have significant exposure to corporate debt and real estate, as these are subject to less liquid assets and they're potentially more vulnerable in the next period. Regarding the credit rating agencies, as part of our engagement with these entities, as we are directly supervising them, we have ensured that they can continue their business. They can also ensure that there is a proper application of the methodologies in terms of rating. It's something which we are closely monitoring, and we are doing that based on the data analytics. We have a lot of information on the CRAs, given that we are supervising them. We are assessing the potential impact of cyclical downgrades of corporate bonds on markets and entities across the financial system. This is something which is work we will continue in the next months because we believe that it's very important to ensure that the efforts which have been put in place by the different governments are, despite the negative economic outlook, will not be lost. So given that the role the credit ratings have here, we'll monitor that very closely. Finally, let me also mention a number of measures that we taken in order to support the issuers in the financial markets. So I think Almoro mentioned earlier about the application of accounting standards for the banking sector. I think there was one part which related to the prudential measures. We took some measure related to the pure accounting, and that was with the objective to ensure that the banks are not negatively affected by the potential by the potential to consider some of the loans as being default, while member states put in place moratoria in order to support the different activities. And I'm sure that you have the similar issue in Asia, because I know that the IFRS is applied there as well. On the other hand, in order to ensure that the investors are protected and they're ensuring and that they are receiving the most updated information, we also issued a statement in which we required all issuers to provide, as part of their press releases or as part of annual report or quarterly reports, the relevant narrative information, the assumptions that they are using in order to assess the impact of COVID-19, and also what are the measures that they put in place in order to address the impact, and what would, where possible, what is the impact on their performance. In the same time, we also allowed companies to report some of the, to provide their reporting with some delays. That was a measure just to make sure that their focus was first of all on the business continuity only, and only afterwards on the reporting side. Maybe just briefly, I would like to mention, I think Almoro also referred to the IOSCO, and obviously Esma, as part of the IOSCO, is contributing to that forum as well. So probably just for you to know, if in Esma we had also like board meetings a week to discuss the situation, it was exactly the same in IOSCO as well. And I think this is a development to ensure that there is an international coordination on the different measures. So we participated there. We are also we also, my chair also took the leadership of our dedicated work stream on rating procyclicality. And we also contributed to the FPR work focused on the assessment and identification of the relevant pressure points in the financial markets. So maybe let me stop here, and I'm happy to answer any question from you, Mark, or from the audience.
Okay, great. Thank you very much, Roxana, for a real comprehensive summary of all the things that Esma has been doing, which are, is quite substantial, in relation to making sure the markets are still opening and running, which is, I know is highly appreciated. And certainly here, it's something we've been recommending very strongly in the ASIFMA region. And we noted that IOSCO obviously confirmed that internationally, which I'm certain that you guys had a very strong part in making sure that message went out. Maybe staying with you before I go back to Mauro, and just maybe looking forward a little bit, you referenced the fact that there seems to be a disconnect between where at least the equity markets are, and even the equity markets and the credit sovereign markets seem there's a disconnect, because there's still, the spreads are, as you say, are still reasonably wide there, but the equity markets are pretty frothy, maybe not as frothy in Europe as they are in the US, but still, probably not reflective of the underlying fundamentals. Not that I'm an equity analyst, but that's certainly what what I've been reading everywhere. I mean, do you, from an Esma point of view, is that something that's concerning to you, considering where we are still in relation to COVID-19 and where we still have to come out of the economy? And if you are, I mean, is there anything that you're kind of monitoring in relation to that that you might think about taking future measures in relation to making sure the markets not only are open but are stable?
Yeah, so I think indeed, well, the market seems to be somehow much more calmer now. I think the question for the coming period is in relation to solvency of corporates and the potential contagion to the financial system. And I think, if we were to look at our risk assessment, and we also put that on our website, I think we see a prolonged risk, a prolonged period of risk, and with possible other market correction. And I think to what extent this risk, the risk in the market will materialize, I think that depends also on two drivers. One is the economic impact of the pandemic, and the second is the occurrence of additional external events in this fragile environment. I think the impact on EU corporates and the credit quality and on the credit institution is of particular concern. So if we add all this together, obviously looking now, trying to move back to the equity markets, I think what is important is to make sure that probably the equity markets are, we find a solution for equity markets to grow again, because the level of indebtedness, both private and public, at a certain point will not be sustainable. And I think in that particular context, as an authority, we don't have much power of necessarily launching certain measures, but in Europe there is this Capital Markets Union project, which I think is even more important than before in terms of recovery. And I'm sure that Almoro can say more about this. I think, but from our side, it's very difficult for us to find measure to stimulate the market. Unfortunately, sometimes the regulatory or the supervision function comes more with things you can restrict, you cannot, things you can forbid companies to do, but not necessarily to stimulate the companies in a certain direction. But I think what from our side, we will be vigilant, and we will definitely continue the monitoring. And I think in terms of providing data to the Commission to make sure that we address those points which need to be addressed, and we don't necessarily go in the wrong direction.
Okay, thank you very much, Roxana. I mean, there's a question here that someone asked related to what we were just talking about. I don't know whether you can really answer it. It says, how does ESMA contribute to the appropriate repricing of stocks affected by the crisis? At least from my point of view, I don't think you really contribute to repricing. That's not your job as a market regulator. You know, unless you're going to take long selling measures where people have to, you know, they're going long stocks that you don't, you know, you're going to stop them doing that. I don't see what you plan to do unless, you know, but if you want to comment on it, please go ahead.
No, I think it's as you mentioned. Indeed, I think, you know, we took that the short selling ban measures were taken in a context in which we saw that clearly there was a wrong direction in the market. But otherwise, I think our role is pretty limited.
Okay, and so maybe tell Mauro to yourself on this, on the futures. You know, we see this dislocation. We see the measures that Europe has taken, which have really gone a long way to stabilizing you know, the situation, and obviously we've seen, as we're talking about, a rebound in the equity markets, even if we haven't seen the, you know, fundamental change in the underlying economics. You know, what happens if we get another wave or two, or we start getting a series of credit defaults? The equity market comes down. I don't want to be a doomsayer, but do you feel that there's still enough ammunition within Europe to stabilize things going forward?
So, Mark, let me do first a bit on the equity side and then on the second wave side. So to complement and build on what Roxana said, I think actually by telling to the markets that to market participants that there is a disconnect between the market, where the equity market where they are, and the economy, I think the regulators do send a signal of sort of disconnection from fundamentals, and so I think they're doing their job, because if the disconnection becomes great, then you run into stability problem, because the correction might then become too significant, and you increase volatility. So from an equity point of view, actually, and a capital point of view, we did part of our objective is to sort of re-equitize the European economy, bring much more equity to firms. Two ways of doing that. One is through the recovery fund. There are a series of more targeted instruments which target precisely solvency support for some firms, or technologies, or value chains, or infrastructure investment. So that is so there's a targeted intervention at the EU level in support, also using the European Investment Bank and the European Investment Fund. So that's a big chunk of our money. It goes precisely in the direction of re-equitizing and investing in key technology. And then from our regulatory side is indeed to give another boost at the project we call Capital Markets Union, which is to scale up European capital markets to bring actually more savings into capital markets. We have a financial intermediation in Europe is still largely bank lending and bank intermediated, and with a more market-based intermediation, actually not only the economy would probably increase the resilience, but also the integration would work better, the opportunities for capital would work better. So we're looking at many aspects. It's a very complex, as all people around the court probably know, capital markets are very complicated setup. And we're looking at the complete chain from what opportunity for investors, for retail investors, actually starting already from financial educations, going to intermediation, and then down actually to considerations related to taxation, because some of the existing taxation which is done at member states level actually works as an impediment for good cross-border investments, or indeed bankruptcy law, because we have 27 bankruptcy laws, and that acts as an impediment in terms of knowledge. So it is a market barrier to some extent, very big obstacle to do, but I think with some courage we will get there. We had a high-level forum group of external stakeholders who did a report last week was published last Wednesday, which is a sort of inspiration. It's out for comments, and then we'll take from there to take a number of actions on the capital market side. And I think it's an essential component of getting the financial part of the European economy better integrated and more efficient. Now, what happens if the downside risk materialize? If the economy doesn't restart, if we get the virus spreading again in Europe, so that's a good question. I don't have the answer, because to some extent we don't know how that would be playing out. What I was saying before in terms of resilience of the European banks shows that there is we have a number of lines of defense there, which is very important. Non-performing loans will certainly rise very significantly. Some sectors, regions might be very impacted, more impacted than others, which makes the recovery financing even more important. Would that lead to, and how would be the transmission to the financial system? Would that lead to financial instability? I'm not sure, because precisely of the resilience. I think the real risk is on the social side, of social and then political side, linked to, and we're seeing that to some extent. We've been in lockdowns, suddenly we're out, and you have all sorts of tensions in the streets, linked and with very different reasons across the world. But it's happening also in Europe, and to some extent it's a normal reaction to when you compress people, then suddenly they flow. So that's where the risks are, I think, more than on the financial side. But yeah, no, it's going to be a complex summer and a complex autumn going forward.
Okay, and maybe Alvaro, staying with you, again, looking forward. I mean, what about the regulatory environment? You know, has there been lessons? I know we're still looking at this and we're still not through it as we've talked about it, but is there lessons learned about how you think potentially the regulatory environment will change going forward? And also maybe even you can comment on, and looking at the time, you know, does this change the underlying sustainability agenda, which has been such a priority for the Commission going forward?
I'll start from the second. On the sustainability agenda, I think it's more important than ever, because the crisis, the downturn, frankly, the sustainable dimension of our economy is more important than ever. The problem has not gone away; it's there. So actually, what we need, and it's also in terms of opportunity, we need to recover in a way which is sustainable in the medium long term. Otherwise, we get problems. If any, it has shown the social dimension of sustainability is also as important as the environmental one. So we're working full steam on all that, implementing taxonomy, working on green bonds, disclosure. So we and Roxana can talk about a lot of that, and maybe we do another webinar on these issues. On the regulatory environment, we've been looking at, so we've postponed the deadlines to simplify, etc. We've been looking at administrative burden issues and trying to simplify, and we're indeed working on possibly a series of targeted measures in the area, in the market areas, for instance, to facilitate prospectuses for issuers, or to reduce some of the burdens related in MiFID. Sorry to use European jargon in that, or to complement the securitization framework. So there, we're reflecting at the targeted measures which actually help the facilitating intermediation, if you want, and without creating risks, and facilitating issuance to get more equity, and facilitating sort of some elements of the securitization, particularly on non-performing exposures and on synthetics, which is important for SMEs. So we're also working on that, and we might come forward with a package later in July, hopefully with also a quick delivery. For instance, the proposals we made on the banks, we may put them out in end of April, and they were approved by Parliament this week, are being approved by Parliament this week. So 1 month for the complete legislative process is a very, very short time. So a significant efficiency of our system to respond to crisis.
And maybe there's a question that came in, and you've kind of already touched on it in the securitization context, but what are the measures to address the expected rise in NPLs is the question.
So there are two sides of questions. One is we will try to ensure that the securitization framework regulation does not hinder the securitization of non-performing exposures. So that's one, and it's based on very good work done by EBA. The second, much bigger question is what we do if there is a significant increase in the non-performing exposures in terms of should we set up asset management companies at national level or European level. It's a much more complicated debate because if you do it at European level, you enter it, it's a real burden sharing. So yes, it would be effective, but it would require a level of sort of confidence on individual banks and individual assets that might not necessarily be feasible in the short term. Probably we'll end up having some national schemes with some forms of either co-financing or some forms of coordination from EU level. But it's too, so that's one of the debates that's taking place, because that's definitely an issue which is taking place here. I guess it's taking place everywhere, because we will all having NPL mountains to climb, be it in Asia or in the US. It will be interesting actually in an Asian context how this is going to be handled, because that's also going to be a challenge.
Okay, great. Thank you, Almaro. And Roxana, looking at the time, maybe the last question to you. And on the same question I asked Almaro about the regulatory environment, I mean, how do you see that from an Esma point of view changing? A lot here we've been talking about measures around work from home and which have been temporary flexibilities. I think it's like both of you are at home now. And, you know, this expectation of being able to do this more is certainly something that our members here want, and I certainly see when I talk to AFME in Europe and ASIFMA in the US that they want, but also even things like electronic. Here a big problem is a lot of things still need wet ink signatures. There's still a lot of physical documentations being filed. So even stuff like that, you know, it needs. You know, we realize that needs to change, and some temporary flexibilities have been given. But are there other things that you see changing in the regulatory environment, and do you see those same things in Asia changing? I just mentioned.
No, I think we see indeed this role of technology and how the technology will be transforming our work. Somehow, let's say that probably for the financial markets, in some way, I think they embedded already this technological change for some time, but now I think we see a need for an acceleration for that. And that will be also, that will facilitate actually, what I think it's a bit more tricky probably you think in terms of, it's true that there are lots of parts of regulation, different requirements. I think that between them now and the moment they're going to be able to make sure that the technology is providing a sufficiently reliable tool, that will have probably a bit of a gap. But I think we will manage to do that. We are on the right trend, and I think in terms of priorities in Europe, I think both on sustainability and technology, these are high priorities. So I think this should help actually moving forward.
Okay, great. Thank you very much for that answer. And I think we're just out of time. And I wanted to thank both of you for giving a very comprehensive overview of what's going on in Europe and how it's actually really worked to stabilize the markets. So thank you very much for that. And I'm going to hand over to Millie now just to give a little bit of summary of what's next for us on virtual events. Millie?
Thank you again for joining us today. Our next virtual event will be on Wednesday, June 24th, China Policy Response to the Crisis. Please reserve your seat by either scanning this QR code on the screen or visiting our website, www.asifma.org/events. We hope to see you there. Have a great evening. Thank you.